Hello, I'm Andy Agafangelo. I'm very, very proud to be the founder of the campaign group Transparency Task Force. We are a UK-based certified social enterprise. That means we exist for a purpose, not to make money, but to try to make the world a better place. And our formal mission statement is to promote reform of the financial sector so that it serves society better. We really have run hundreds and hundreds and hundreds of events. We've run dozens of book club meetings. And what we normally have is a really interesting person talking about a really interesting book. But today we've got Diana with us, and Diana is going to be talking about not one, not two, but three books, every one of which is a bullseye hit on the topics that are of interest to Transparency Task Force and the 5,000 or so people that get our communications and participate in our activities around the world. In fact, in 21 countries. We are a very international community of campaigners and activists who are working hard together to try to get the financial services sector to behave the way it ought to. Before I go any further, I really do want to emphasize something. There is absolutely no doubt in my mind that the financial sector is profoundly important to the well-being of society, to economic stability, and off the back of that economic stability, to political stability too. I say this because I really do want to emphasize the fact that I and the TTF are fans of the financial sector so long as it is behaving itself. However, as we all know, from time to time, its predisposition to misbehave gets in front of itself. We have all kinds of scams and scandals and market crashes. And those market crashes, for example, the global financial crisis from not that many years ago, not only cause huge financial carnage and economic turmoil around the world, they also cause horrific levels of human suffering. So, what we're talking about tonight, the behavior of the financial sector through the three books, A First Class Catastrophe, Taming the Street, and The Wizard of Lies. Three books are all about things that matter to me, matter to you, matter to all of us, matter to everybody. And I'm not exaggerating when I say it, that when I had the chance to speak to Diana yesterday about tonight's event and what we were going to cover and so on and so forth, I came away from that conversation feeling I had just had a conversation with somebody whose understanding of the topic is well beyond expert. It takes us into the territory of insights and understanding that can only really be described as wisdom. And that word wisdom is important. Let me tell you why it's important. Because what Diana has the ability to do better than anyone I've ever spoken to before about these topics is to provide a very well-grounded academic and historical understanding of the patterns, the ebbs and the flows, the way crises eventually lead to calls for regulation, that eventually lead to protections put in place to protect consumers and to make the markets more stable. But then the almost iterative process of those protections and that regulatory activity being unwound and the pendulum starts swinging back the other way. And honestly, listening to Dinah speak about these things just gives such clarity. It's a real gift. It's a real gift. Um, what I'd like to do now is very simply pass over to Diana to invite her to speak her truth, to talk about her books, the movie as well. And once Diana's completed that, which I know is going to be very, very interesting for all of us, we'll try to turn this into as realistic an online conversation as we possibly can. The next thing we're going to do, folks, is invite you to join me in showing our appreciation to Diana. It's a real piece of fortune that we've got Dinah with us tonight to talk about her books. I know you're going to enjoy this, folks. Please give a very, 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 very special warm TTF welcome to Dinah, who's going to talk about her books. Dinah, over to you. Thank you so
Thank
very
you.
much. Thank
Thank
you.
you, Andy. My passion is financial history, and my hopes are that I can be a way that financial history can inform our current values, our current decision making. And so it's hard for me to imagine a forum better suited to what I set out to do than this one. So I am so very grateful, not only to having been invited to talk with you, but having been given the option to give you an overview of my work that I hope you will find useful in your own mission and in your own efforts. It's a fact of life that those who do not learn from their mistakes are condemned to repeat them. Not original to me. The books I've written since the 2008 financial crisis deal with some big mistakes made in the United States. But I think the lessons of those mistakes can and should be read more broadly. After all, financial history is rooted in human nature. I can't say that enough. And human nature doesn't vary a lot from continent to continent, or, of course, from one century to the next. Like many authors, I suspect, I never write the introduction to a book until the book itself is written. And that's because I never really discover what the book is truly about on a deeper, more universal level until I finish drafting it. And sometimes it's a discovery that surprises me, as it was in the case of all three of these books. Take The Wizard of Lies, which was my 2011 book about the global Ponzi scheme run by the American con man, Bernie Madoff. Now, like many people, I initially expected that Madoff's story would echo the old fable about the emperor's new clothes. That timeless warning about self-deception seemed to explain how so many people could have been fooled by Madoff for so long. But I was wrong. When I finished my first draft, I saw clearly that what I actually was writing was a sequel to Dr. Jekyll and Mr. Hyde. Bernie Madoff was not some inhuman monster like Mr. Hyde. He was the kindly Dr. Jekyll, someone we justifiably trusted, never suspecting the demon hidden in his soul. Similarly, my goal in writing A First-Class Catastrophe, which came out in 2017, was simply to produce the first comprehensive history of the worst single day in Wall Street history, Black Monday, October 19th, 1987. The anatomy of a market crash. That's what I thought I was writing until I finished the draft. And then I began to see that the real story, the story that makes that decades-old crash relevant to this very day, is that I was writing a version of The Sorcerer's Apprentice. I hope you're familiar with that wonderful tale that Walt Disney brought to life so terrifically. Technology and growth were like magic spells in the decades after World War II. And Wall Street and Washington were like the clueless apprentices, playing around with this magic, unable to control it or even understand it, and unleashing this powerful magic blithely into the world. For my 2023 book, Taming the Street, I once again thought I knew what I was doing. I was trying to pull together, again for the first time, the rich narrative history of just the financial reforms that President Franklin Roosevelt put at the heart of his political platform in the 1930s. Now, obviously, there's been a vast amount of scholarship about Franklin Roosevelt and his historically long presidency, one of the most consequential and event-filled presidencies in U.S. history. But the focus on his financial reforms has been astonishingly small, and I knew that that was a hole that I wanted to fill on the Roosevelt bookshelf. But once again, it was only after the book was drafted that I saw what it was becoming, and that is a survival guide for preserving a fair, healthy society in the face of the bottomless human appetite for more money, more power, more freedom from restraints of any kind. FDR showed us how our greed could be tamed, and more importantly, he showed us why it must be tamed if democracy is to flourish. So let me look at these three stories from our present predicament, mine and yours, and suggest some lessons that we might take from them today. I've known Bernie Madoff for nearly 2 decades before most of American investors had ever heard of him. He was a source for me and some other financial journalists on the challenging topic of stock market structure. Now, this is a topic that makes editors' eyes glaze over, I can promise you from experience, but an incredibly important topic for how capitalism works and who it serves. As that structure underwent revolutionary changes in the late 80s and 1990s, Bernie was the guy who helped us understand what was going on. He had a gift for putting these esoteric and complex ideas into common language that we could understand. He ran one of the most technologically sophisticated firms on Wall Street, and his firm was one of the few NASDAQ firms to function competently on Black Monday, when most of the NASDAQ market simply fell apart. Madoff played a significant role in working with regulators to produce stronger rules after that crash, all of which is to say, he was a man worthy of respect and trust. He did not look anything like the stereotype of a Ponzi schemer, an arm-twisting bon vivant pushing some outlandish investment that was obviously too good to be true. That old jazz age stereotype was obsolete long before Madoff came along. He didn't twist arms to get investors. He turned them away, and they begged him to take their money anyway. He was quiet, sober, reserved. Most importantly, he never offered the vast bulk of his investors anything that sounded too good to be true. One fraud analyst who studied the Madoff case put it better than I ever could. He said, "If it sounds too good to be true, you're dealing with an amateur." Madoff was a pro, and he knew to make his product sound just good enough to be attractive, but never too good to be true. Bernie didn't sell promises of overnight wealth to greedy people. He sold safety and simplicity to baffled, frightened people. And none of that fit the Ponzi scheme stereotype in the minds of investors, or sadly, in the minds of regulators. Madoff stands for the threat of the trusted criminal, one of the biggest challenges regulators face. The trusted criminal is as much a threat to us today as it ever was. When we think about protecting ourselves in our financial life, we think about locks and passwords, but trusted criminals don't need to pick the lock. We give them the key because we trust them. They don't need to hack into our computers. We trust them with the passwords. Now, science says we are hardwired as a species to trust one another. It was no doubt very handy out on the savannas when we were forming hunting teams to track down the woolly mammoth. But since we are hardwired to trust one another, that willingness to trust can blind us to the threat of the next Bernie Madoff. Now, we can't operate a modern economy or a livable society without trust. But trust is the very weapon, and indeed the only weapon, that people like Madoff need to destroy our financial well-being. So one lesson of the Madoff story is figure out how to protect yourself, not from the next Madoff, but from your own innate impulse to trust other people. Come up with some rules that will keep the red flags visible, and then stick to them without exceptions, without waivers, without special dispensation for those whom you trust the most. And these guidelines are as important for the regulatory approach to dealing with this brand of fraud as it is to our personal financial lives. Now, it sounds easy. One of those rules isn't, though. Probably one of those rules should be don't do business with family or friends. Ooh, that's a little harder. But you love your family and friends. You love them and you trust them, and you will not see it coming if they betray you. So Hard lessons from that experience, but very useful ones. The lessons of the 1987 crash, I think, are staring at us from the headlines every single day. Most of the financial crises in our modern history, the panic of 1907, the 1929 crash, and even the 2008 meltdown, are remembered primarily for what came next. After 1907, the birth of the US Federal Reserve Bank. After 1929, the Great Depression. After 2008, the rise of virulently populist politics. But the 1987 crash was different from those. It was important, critically important, not because of what happened after the crash, but because it showed us what had already happened in our financial landscape. In the decade before that crash, the world of finance had undergone historic changes in scale, speed, and complexity, and we did not realize, we as investors, we as regulators, did not realize the impact that those changes were having. In the late 70s and 80s, pension funds and endowments, giant institutional investors, began for the first time to pour money into the equity market. Computers gave rise to the first algorithmic trading strategies, which permanently linked up markets that had long been separate and self-contained. The futures market, the options market, the stock market, and the global versions of all of those US markets. Traditionally, each had been separate pools of investors with separate regulators. But when those new high-powered strategies were widely adopted by titan-scale investors everywhere, all those separate worlds were lashed together. And this magic very quickly ran out of control and gave us Black Monday and the financial landscape we're still struggling to competently regulate today. And yet today, we have a brand new bunch of sorcerers' apprentices on our doorstep. They're telling us how wonderful life will be when we embrace artificial intelligence and let blockchain technology replace our old-fashioned currency and banking system. Our financial history suggests it will not be that simple. In Taming the Street, I was surprised to discover how central financial reform was to Roosevelt's New Deal and how passionately he cared about it when I began digging into his personal papers. Facing a suffering and a deeply, deeply divided nation that was wavering between a socialistic left and a fascist right, Roosevelt believed that the only way to protect democracy from either version of tyranny was to nurture a fairer economy, a more honest, less ruthless form of capitalism that served all Americans, not just the rich and powerful. The depth of his anxiety about democracy's survival is reflected in an anecdote about a conversation with a White House visitor soon after he took office in 1933. The visitor supposedly said, "Well, Mr. President, if you succeed in curing the Depression, you'll be our greatest president. But if you fail, you'll be our worst president." Roosevelt quickly replied, "If I fail," he said, "I'll be our last president." He did not think democratic capitalism could survive unless it started serving those it had previously left behind. I show how FDR persuaded the American voter that regulation would be healthy for everyone, Main Street and Wall Street alike. And that is the very argument we need to make to voters today. He promised voters stronger bank regulation, federal oversight of the nation's stock exchanges, and laws that would require Wall Street to tell investors the truth about its products. In his famously busy first 100 days in office, he won approval for historically important financial reforms, including legislation that curbed bank speculation and created the FDIC to ensure bank deposits. A year later, he created the Securities and Exchange Commission to be the very first cop on Wall Street, regulating stock exchanges and their member firms and guarding against fraud and market manipulation. In 1935, He pushed through limits on the complex corporate pyramids that controlled the nation's gas and electric utilities, which drove economic growth in the 1930s as powerfully as Silicon Valley does today. In 1938, FDR signed a law to regulate over-the-counter dealers, laying the groundwork for the NASDAQ market of today. Finally, in 1940, FDR signed a pair of laws to regulate the American mutual fund industry, which has since become the mainstay of retirement savings for tens of millions of ordinary people. These reforms were widely adopted and adapted by market economies around the world. We simply would not recognize the global financial landscape today if the reforms of the New Deal had not been put in place. But I can tell you roughly what that landscape would look like. It would look like the unregulated financial world of the 1920s. In that era, America did almost nothing to protect ordinary savers and investors. Bankers were free to speculate with other people's money, and bank failures were routine. Each failure typically would wipe out the depositor's savings overnight, and small business loans would be called, local credit would dry up, and local economies would suffer. Stock exchanges operated like private clubs, very wealthy private clubs, more concerned with protecting their members than with protecting the public. Price manipulation was routine, even on the most lauded exchanges. Punishment for it was rare. Beyond the stock exchanges, the vast swamp of unregulated over-the-counter dealers regularly engaged in blatant fraud that local law enforcement struggled to recognize or much less control. The stock market crash of 1929 and congressional hearings in the early 1930s revealed a level of ambient misbehavior by American business that is still shocking. And I say that as someone who is not easily shocked by business misbehavior. So when we hear calls for financial deregulation today, and we do, and we will, we must remember that no one making those calls, at least in the US, has ever lived in an unregulated market. For more than 90 years, they have lived their lives and built their fortunes under Roosevelt's rules, the very rules they now want to erase. Now, this is just crazy. You don't decide to throw away your umbrella in the middle of a downpour because you're still nice and dry. You're still nice and dry because of the umbrella. And you don't throw away the rule book to make markets prosperous and healthy. They are healthy and prosperous today because of the rule book. When you come right down to it, deregulating finance, if you look at our financial history, makes as little sense as deregulating traffic. Imagine that we took away all the stop signs, the traffic lights, the speed limits, the lane markings. We'd be left with nobody on the road except the well-armored tanks of the gigantic investors, the hot rods of the crazy speculators, and the armed bandits gunning for both of them. There'd be no room on that financial highway for the likes of you and me. Which brings me back to my opening theme about those who forget their mistakes. We forgot our jazz age mistakes and plowed ahead with an unregulated cryptocurrency market. We've allowed huge tracts of our financial landscape, private equity, venture capital, swaps, and similar arcane derivatives, to operate largely without regulation. And we will pay the piper for that. Some bills have already fallen due in the crypto market. History makes that abundantly clear. Previous experiments with deregulation of savings and loans, hedge funds, investment banks have not ended happily for ordinary citizens, and future experiments won't either. The criminality in the crypto market is only a surprise to those who have no idea what happened on Wall Street in the 1920s. If that includes you, please take a look at Taming the Street. It's a rollicking good story, but I think it also has some important reminders and a useful battle plan for those of us who are trying to address the world ahead. So that concludes my formal remarks, and I'm really looking forward to the question and conversation to come.
Diana, that was absolutely fantastic. I wrote down verbatim, I think I've captured it. One of the best lines that I've ever heard about this whole deregulatory agenda that seems to be at work on both sides of the Atlantic. You don't decide to throw away your umbrella in the middle of a downpour because you're still nice and dry. You're nice and dry because of your umbrella. I absolutely love that. There is so much wisdom in that. There is so much wisdom in that. Folks, before we do anything else, let's show our appreciation to Diana once again. And
Thank
then
you.
I'll kick off with a few initial thoughts and
Sure.
comments and questions myself, and then we'll throw it open. Let's have a
Good.
really lively debate, so to speak, amongst ourselves. Diana, I mentioned to you yesterday that it seems to me we as a species have the capacity to unlearn that which we thought had previously been learnt and become hardwired into our, if you like, into our DNA, into our habits. What is it? What is it about people, do you think, that creates the capacity for us to almost start thinking of lessons of the past as irrelevant and obsolete and distant and to be ignored? What is it about people that does that?
Well, there are, a neuroscientist could give you all sorts of wonderful cognitive function reasons. In part, and of course, I'm talking up my own book, as they say on Wall Street here. I'm talking my own portfolio, but in part, I think it is just a widespread lack of understanding about our financial history and about our history in general. I've been astonished as politics have unfolded here in the States, at how few of today's voters have ever heard of Joe McCarthy and the McCarthyism period. I was joking with a younger friend. I said, I look ahead and I'm fearful of hearing the question, are you now or have you ever been a Democrat? Now, that question, are you now or have you ever been a communist, was the headline of the McCarthy hearings in the 50s. I get this glazed over blank look. So I think partly we're constantly caught in the gaps of our near-term history. We understand the history of the last century worse than we understand the history of the 12th century. We just don't study it enough, and it's still the subject of so much argumentation. So I'm not sure why we refuse to learn the lessons that we thought that we've learned. Roosevelt was as frustrated as you are, Andy. He said in his campaign for re-election in 1936. Of course, by that point, Wall Street was back on its own. Let me just intercede here. The day Roosevelt took office, we did not have a functional banking system in the United States. Every major bank in the country was closed. The ones that weren't closed were restricting withdrawals. The New York Stock Exchange and all the smaller stock exchanges around the country were closed. We did not have a financial system on March 4th, 1933, when he took the oath of office. So that's what he was facing. He saved the banking system. In 2 weeks, he restored public confidence in the banks and got them reopening again. By 1936, when he ran for office, business was healthy again. Banks were functioning, Wall Street was functioning, and they wanted nothing to do with the New Deal. They wanted nothing to do. And Roosevelt used a joke in a campaign speech in Chicago, where he said, there were no complaints about Dr. Roosevelt, Dr. New Deal, back in 1932 when they were in the hospital. He said, "I'm pleased to announce that many of them have recovered so much that they can now throw their crutches at the doctor," which they were doing, blaming the doctor who had bailed them out. So I'm not sure why we fail to take these lessons in, but I think it can't be said too often enough. You've got to read the minutes of the last meeting. I say this to young reporters whom I train and mentor. You've got to know the history before you can put what's happening today in any kind of context.
Dana, this really, really is fascinating. Do you think the folks who are involved in promoting the narrative that there needs to be more economic growth and that regulation is red tape that gets in the way of the growth, therefore get rid of the regulation? Are these people, are these individuals, in your opinion, um, rationalizing the way forward? What I mean by that is, do they actually not see the dangers? Are they so kind of myopic and blinkered that we must have growth at all costs, that they are blind to the risks that the philosophy might take us into?
Well, I think inside each one of us is this 4-year-old that doesn't want to be told what time to go to bed. None of us like to be told what to do. And I think our instinctive resistance to any sort of government regulation, even in the public interest, arises to some degree from these somewhat juvenile responses. But one thing that needs to be corrected in their argument is this, and it's amazing how easily we make the connection, that it's a trade-off between regulation and growth. There is absolutely no evidence of that. There's no evidence that economic growth suffers in a well-regulated
Yeah,
economy.
yeah,
So that's a straw man, and that's absolutely a straw man argument. It isn't trade-off. To which I will point to the period after the New Deal. Roosevelt brought in an unprecedented degree of business regulation. I itemized some of the biggest of his legislative achievements. They were all in place before the World War II economic spurt brought the United States a full economic recovery from the Depression. What happened in the decades after? We saw the greatest economic growth in our history. Indeed, even in the years of the New Deal, before war in Europe started to increase orders to our US economy, the New Deal sustained economic growth of historic proportions year after year with these new regulations. Now, of course, they were recovering from a debacle of the Great Depression. That has to be said. You do get 10% growth if you're starting from near nothing, right? But he had an extraordinary track record to point to. The 37 recession gave his critics a chance to say, oh, it's all your fault. It's your fault. It's all those regulations. And then, of course, it turned out that no, it wasn't. It was that the Fed had tightened money too much and the government had cut back on its own fiscal stimulus too early.
yeah.
And the economy was not strong enough to sustain it. Once those mistakes were corrected, economic growth soared ahead. So I would say the way to deal with that is cut it off at the root. Where is your proof that regulation and economic growth are not compatible? I don't think there is any.
Truly remarkable. We'll go to JB Beckett in a moment, and you might have noticed earlier, JB made a comment about your work, the book, the film, Madoff. JB's one of the many people in the TTF community, Diana, who's got a lot of knowledge and a lot of wisdom in himself, and it's great that JB's with us tonight. Next up is going to be Mark Falcon, similarly, and another very, very well-informed individual who I'm sure is going to enjoy tonight's session very, very much indeed. Just before we go to JB, given that I know he's a fan of the movie, could you please, Diana, tell us a little bit about your involvement with the world of
Oh,
movie making? Go on, spend a few minutes telling us
it
what
was,
that was all
I
like. Go
mean,
on.
it was like, as I told Andy earlier, it was like a chapter from someone else's memoir that dropped into my life. I mean, it was totally unlooked for. When The Wizard of Lies came out in 2011, Robert De Niro was immediately interested in playing that character. And his production company, Tribeca Films, on the strength of their interest, went to HBO, and HBO optioned the book for production as a film. Now, 90% of option properties, the movies never get made. I mean, and that's what my agent warned me and said, don't get your outfit for the Oscars yet. It's unlikely to happen. So it took a couple of years for them to find a script writer that they were happy with. But eventually, in 2015, the movie was filmed. In advance of that, I had a long coffee date with De Niro to talk about uh, my personal knowledge of Bernie Madoff. I mean, he was trying to build his characterization. Fascinating to watch him work. He's just like a vacuum cleaner, sucking up every little detail. Things like, okay, do you remember? Did Bernie call the kids his sons or his boys?
Wow.
There's a different distinction. One sounds, and the other said, I got it. Let me think. Go back to the interviews, go back to my notes. And I was able to answer those questions for him. So we got along very, very well. And he went back to the movie's producers and said, and director, and said, you're looking for somebody to play a reporter. We got a reporter. Why don't we ask Diana to play herself? And of course, I was stunned, staggered, immensely flattered. And then I learned I had to take a screen test. I had to audition to play myself, which was, let me tell you, a psychological hoot on many levels. I passed the screen test, fortunately, and got to be involved in the making of the movie. My scenes were principally with De Niro. I was the reporter interviewing him in prison, as I had done in real life, interviewing Bernie Madoff twice in his prison in North Carolina before his death. So I was playing myself in real life. But I was also behind the scenes, you're on the sidelines watching this movie get made. And it was just such a thrill. I'm always happy to report that, when someone who stands very high in public esteem and is very, very famous, it's lovely to report that they are also a lovely guy. He was so generous and so patient with this newbie star who was sharing the screen with him. That I will be forever grateful for that. But it was a wonderful experience. It was really great fun. And it's a great movie, I think. I told Andy I'm probably the only happily adapted author in America. I was really pleased with the work, with the way they adapted Wizard of Oz for the screen. I was pleased with the emphasis they put on the victim's suffering. I was pleased with the balance they struck between humanizing and glamorizing. I thought that was the toughest call to make, not to glamorize Bernie Madoff, but to humanize his story. And so I was really pleased with how it turned out.
Well, what a fascinating story. What an amazing movie. I can't wait to watch it again. I think I've watched it once or maybe twice. So I know I've watched it once, maybe twice. I can't wait to watch it again. JB, I reckon you'll be beating me to it to watch it again. JB, over to you, sir. Thank you very much. Thank you.
Thanks, Andy. Yes, I think you're right. And yeah, Dan, I'm a big fan. So apologies for the fanboy over the next couple of minutes. I don't know which questions to ask you. I have too many, and I'm very respectful to everyone else is here. I think there's probably just two questions we're going to ask you for now. If I get the chance later, I'll maybe ask you some more. The first one is, in terms of regulators, the SEC, what does the vain attempts by Harry Markopoulos to essentially flag what was going on, and it was then ignored for such a prolonged period of time. What does that say to regulation in the United States at that time and the SEC at large?
Well, as I've said so many times, the biggest failure at the SEC was a failure of imagination. They simply could not imagine, locked as they were in these stupid but stupidly durable stereotypes about who commits fraud and what it looks like out in the wild. They were locked in these stereotypes that just blinded them to what was really happening with Madoff. And it must be said too that Bernie was as lucky with his enemies as he was with his friends. Harry was I know Harry. I went to his book party. I think the world of him. But he's a squirrely little guy, and he was difficult to get along with. He alienated a number of people at the SEC. And it must also be said that in his book, Nobody Would Listen, which I recommend, but in his book, at the end, he includes as an appendix what he showed regulators when he first went to blow the whistle on Bernie. And when he first approached a Wall Street Journal reporter who sadly was already ill with the disease that would kill him before he could take up this story, what he showed that reporter. And I have to admit, if he had come to me a financial investigative reporter at the New York Times, if he'd come to me with that brochure, with that, I'd have been hard put to get it in the paper, because there was a tremendous amount of speculation, proving that Bernie was not pursuing the strategy he claimed to be pursuing required you to prove a negative. You had to prove that he was not dealing over-the-counter derivatives with any bank in the world. And even to this day, I defy anybody without subpoenas and handcuffs, that is to say a journalist, to take that on. It's very hard to prove someone is not doing something that they say, that they claim they are doing. So partly it was the difficulty of proof. Partly it was the stature of Bernie Madoff in the eyes of regulators. And partly, it's got to be said, because every jurisdiction is facing the same problem. The SEC was starved to death. It had been starved to death for decades. It didn't have enough people. It didn't have enough horsepower. There were at least 2 occasions I document in The Wizard of Oz where if they'd been able to get on a frickin' plane and go to London and serve a subpoena to one of your banks, they would have known. But they didn't, they couldn't, they didn't have the money. And in the midst of one of the most far-reaching investigations, when they were this far away from finding out there was nothing in Bernie's depository trust account, they got called off on another huge investigation of the U.S. mutual fund industry. Now, I can understand the triage that had to be done there. 35 million Americans have their retirements in mutual funds. Bernie deals with a bunch of rich hedge funds. I'd have made the same call. But the fact that they had to make the call was the consequence of really poor funding for the regulatory apparatus.
If I may, Diana, and apologies to everyone else here, if I may just ask one other question. Given the tale of the tape of what Bernie committed as an individual and the way he went about that and his motives and the way he executed it, compared to what was brewing behind the scenes at a much greater scale in the likes of Bear Stearns, in terms of what we saw in the collateralized mortgage-backed sector, in the collateralized loan industry, that obviously was going to lead to a much larger crash of the whole system.
Yeah.
When you try to compare, I guess, the morality of those two examples, is it right that we make Bernie a monster, and by and large, most of the perpetrators of the much larger crash are still around today, unprosecuted, and seemingly still very wealthy and well off? How do you reconcile that?
Well, it's hard. It is hard to reconcile. I mean, it must be said that a Ponzi scheme is the oldest crime in finance. It's robbing Peter to pay Paul. It's gone on for centuries. There was nothing uniquely tied to the 2000-2008 time period that empowered Bernie, except for the loosening of regulations on hedge funds, which pulled a lot of what would have been retail investors into this less disclosed, less transparent field of investment. So to that degree, he benefited from the regulatory step backs that had been made in the decade before he was exposed. He did become, sadly, the face of the crisis, the poster child of Wall Street greed and indifference and recklessness. In fact, obviously you could say anyone who runs a Ponzi scheme is incredibly reckless, but in fact, he was very careful as a reckless Ponzi schemer. He did not take a lot of money out of the scheme himself for his own use and consumption. He husbanded the cash that he had in so that he would have enough available to cover withdrawals, since he wasn't making any money. He could only rob Peter to pay Paul, but he was very careful to hold on to all the money he took from Peter so it would be available to pay Paul. So in a way, he was a very conservative, kind of classic Ponzi schemer. And the world of Wall Street had gone off in a very different direction. It will be amusing to you to know that Bernie disagreed with all of that. Bernie was very critical of what Wall Street banks were doing and how reckless that they were becoming, and back before he was arrested, and then the long conversations we had after he was in prison, would decry the sins of the bankers. But I think part of it comes down to simply this human capacity to ignore what you can't put a face on. That famous phrase, the face in the crowd. Well, you notice the face in the crowd, you don't notice the crowd. It's hard to focus on a crowd of misbehaving, reckless bankers. But Bernie, standing there in the dock, is much easier to focus on. But I do share your bafflement at that. In a way, he was wrongly tainted with responsibility for anything that happened in 2008. He would have done anything to avoid what happened in 2008 because that's what brought him down.
Yeah.
The fact that frightened investors needed money, and his was the easiest money they could get back, was what caused the cash run that pushed him into prison. So it's not fair, but no one's going to give me an award for being fair to Bernie Madoff. So there you go.
Great questions, JB. Thank you very much indeed. We're going to go to Mark Falcon. Mark, if you can turn your camera on, that would be great. And then share your thought. Thank you, Mark.
Thanks, Andy. Thanks, Diana. I really enjoyed your talk, and I'm really excited to read Taming the Street. Now, you maybe know that one of the best reads of the week is the TTF newsletter, which always has a great quote in it. And I'm sure that one of the quotes that's been there is Bismarck's quote, that only fools learn from their own mistakes, the wise learn from the mistakes of others, which seems to echo, and I'm sure you thoroughly endorsed and advocate. But do you, how significant do you think it is the fact that that Roosevelt came from a very privileged background, but at the same time, obviously suffered from a crippling illness, and indeed is that one factor that made him much more sympathetic to others, and to recognize that we all depend on each other, and that the Americans' spirit of individualism, when taken to radical individualism, almost as you say, of no rules, is ultimately toxic and absolutely destructive to capitalism.
Well, I think that in addition to polio, I agree with your thesis. In fact, in Taming the Street, in my account of Roosevelt's campaign against Herbert Hoover in 1932, in the 32 election, I contrast Hoover and Roosevelt, saying that Hoover subscribed to the theory that everybody could pull themselves up by their own bootstraps, and Roosevelt knew that Roosevelt needed help even putting on his boots and standing each morning, and he understood that out of the blue, anyone could suddenly be hit with a bolt of bad luck through no fault of their own that would render them helpless without the help of other people. He had a bright political future before he was struck by polio in 1921. He had actually run for vice president of the United States in 1920 against Warren Harding. It would have been nice if they'd won that race, but they didn't. But I think there are two factors besides his experience with polio that humanized him and made him more empathetic to the suffering that the American nation was going through. Yes, polio was one. Eleanor was the other. Eleanor Roosevelt came out of a tradition of sort of noblesse oblige, in which the family she was raised, and she was Theodore Roosevelt's niece, President Theodore Roosevelt's niece. These were the Republican Roosevelts. She was raised in a tradition where young ladies like herself did good works. She taught in a settlement house in New York City. She got her skirt hem dirty with the sidewalks of Lower New York, Lower East Side of New York. And she took Franklin with her. She brought him into this world that she was working in a charitable way. And throughout their long partnership, it was a partnership more than a marriage, as we know from the scholarship. But throughout that long political partnership, she was his true north of human compassion. He had been, I think, dramatically changed by his experience with polio. James Tobin wrote a wonderful book called The Man He Became, which focuses precisely on that psychological impact on Roosevelt of polio. But I think he also was blessed with a partner who also was able to keep his eyes open, keep his heart open to what was going on. And it's hard for us to appreciate now how dramatically different his expressions of empathy were from the ambient political culture at the time. I had the occasion last fall in October of attending a gathering of conservative historians and economists and policymakers who were largely kind of part of the Calvin Coolidge fan club. And they were having a conference in Washington. I was invited to attend thinking I was going to be Daniel in the lion's den there. And there was a bunch of reading we had to do of people who had been contemporaneous critics of the New Deal. Andrew Mellon, this Treasury Secretary, Herbert Hoover, people who had critiqued the New Deal at the time. And reading through them, I was stunned by how much every single one of them minimized the suffering of the Great Depression. You will look in vain for any recognition, any admission that Americans were suffering in great numbers. This is with 25% of our workforce out of work. People were scrounging landfills for food, living in caves in Central Park. And the critics of the New Deal just refused to address that suffering. So when Roosevelt came forward and said, I know you're hurting. This is not tolerable. We cannot have our people suffering like this. It was like a thunderclap in the political weather. So it was, I think it was genuinely who he was, but it was also very politically smart to express that empathy and that compassion, because it distinguished him so sharply from the more conservative right-wing forces that he was campaigning against.
Diana, that was a really interesting response to a great question, Mark. Thank you. You're making me, just before we go to Philip Meadowcroft, this conversation we've just heard is making me think about something that's happened quite recently, which I find upsetting. I mentioned to you when we spoke yesterday, Diana, that the All-Party Parliamentary Group published a report about the regulator, and I know that some people have responded to that report by effectively trying to frame the problem as the people who've been harmed by catastrophic regulatory failure are people who basically like to whinge. And
Yeah.
that is so upsetting to hear
I'm so
it.
glad you asked that, because that reflects one of these obsolete stereotypes that we simply have to free ourselves from. In the 1800s, in the 19th century, when Charles Ponzi had not yet given his name to Ponzi schemes, there were a lot of financial scams that were predicated on the sucker, the mark, helping the con man do something a little bit dishonest. This was standard fare in 19th century crime, financial frauds. It is from that era that we get the old adage, you can't cheat an honest man. Well, that's just ridiculous in modern terms. Honest people get cheated every single day. But these holdover ideas that, it sounded too good to be true, you should have known that it couldn't be true, you were greedy and that's how you got cheated. That that attitude about blaming the victim reflects an era of financial crime that's a century behind us. It bears no resemblance to the kind of financial crimes that are operated on today. And to the extent that that kind of thinking gets embedded in our regulatory frameworks, in our regulatory responses, it is poisonous. It is toxic. People are ashamed to come forward. They're ashamed to testify.
This is so,
and it's just wrong.
This really is so incredibly important, because we'll come on to this shortly, Diana. We have to talk about what's going to happen next on our side of the Atlantic, on your side of the Atlantic, because there's, frankly, you used the word fearful earlier. Myself and others are fearful that we might be at the top of a very, very slippery slope towards the wrong kind of deregulation. Deregulation to get rid of unnecessary duplication and red tape and friction that doesn't need to be.
That's not deregulation. That's streamlining. That's
precisely
modernization. No one could be opposed to that. That's not what that's the sheep's clothing that the wolf is walking in wearing. Yes, we need to do that, but what they really want to do is eliminate the regulations. One of the close advisors to our president-elect, tossed out a trial balloon the other day. Well, why don't we just get, we need to save money. We need to have a more efficient federal government. Why don't we just get rid of the FDIC, our bank deposit insurance scheme? Well, clue to clueless person, the FDIC doesn't cost the government any money. The banking industry pays for it. And they get rewarded for paying for it with people who trust their banks. Yeah. So that ignorance of, we could save money if we got rid of FDIC. No, you wouldn't. You wouldn't save a penny of government money, and you would leave yourself exposed to the kind of bank runs that decimated the economy in the 1920s. Read your history books. So I think there's a legitimate space in the conversational box for streamlined regulations, elimination of fragmented, balkanized regulatory systems, which is our big problem over here. You at least have like a near unitary regulator, however competent it may or may not be. We've got dozens, we've got 50 bureaus of state securities overseers. We've got 50 state banking regulators, and we've got a half a dozen major regulators in Washington. And all of them have their turf, and all of them have their congressmen who oversee their activities, and those congressmen all get campaign contributions from the industries that are regulated, and no one's interested in getting it together. There have been 3 studies of the U.S. regulatory structure since 1987. The first was the Brady Commission report after the 1987 crash, which I deal with in First Class Catastrophe. Its primary observation was, we were regulating this like these were all different markets. They are one market now, and we need one regulator who can have a 360-degree view of what's happening. That was ignored then. The same advice was proposed after the 2008 meltdown. We need a single regulator that has a view of everything. It was ignored again. And even in Trump's first term, his Secretary of the Treasury put out a major report on the capital markets, and guess what one of its key observations was? We've got this balkanized regulatory system, and it doesn't serve us well. So, we definitely need to end balkanization, to streamline the rules that are there. But so far, every example I have seen of calls for deregulation are not that. They are not, here's a set of ways to make this regulatory structure work better. It doesn't work, get rid of it. So I think there's a lot of keen ground to be gained by forcing the deregulatory chorus to make that distinction. Well, are there no rules that you'd like to keep? I mean, do you see any merit in any of the regulatory structure? How do we make it better? Not how do we eliminate it?
The timing of this conversation is just so apt because of what's happening in the UK now and will be over the next few months. Diana, thank you so much. We'll go to Philip Meadowcroft, then to Chris Toby, then I think back to JB. And when we go back to JB, please do talk about Thatcher, talk about Reagan, talk about the repealing of Glass-Steagall and all those Hayek type things I know you know so much about, because I think that's going to take the conversation to what do we want to happen in the future and what can we do to make it happen. So we'll get to that shortly, JB. Let's now go to Philip Meadowcroft. Philip, lovely to have you with us, sir. Please do share your thought. Thank you.
Good evening. Thank you, Andy, and good evening, Diana. Thank you for a beautifully colourful narrative of Wall Street in the 30s and the 40s. It really was quite enjoyable there. I think my question, Andy, you've stolen a bit of my thunder, and so has my friend Tony Johnson in his question. We've got regulatory control in the UK, and for the most part, it's not very well respected. And I'm particularly thinking in the financial area. And Andy and TTF have got considerable activity in trying to sort that out. And we have a Labour government in power at the moment who is talking about deregulation, possibly not quite in the context that you have just been talking about it. Less of the streamlining and more of the chucking out altogether. I'm going to pose my question in a foreign language, which may be the first time it's been done in TTF meetings. Quis custodiet ipsos custodes?
Who is watching the watchers?
Yeah.
Who is guarding the guardians?
I say no more.
Yes. Let me show you, let me offer in response as a thought experiment, a fact of life in Roosevelt. I mentioned it in Taming the Street. In the early years of the Securities and Exchange Commission, now his first chairman was Joseph Kennedy, who went on to become a complete botch as ambassador to the Court of St. James. But Joe Kennedy was the first chair, Jim Landis, and William O. Douglas, who went on to our Supreme Court subsequently. Each one of those three men had walk-in privileges in the White House. When they needed to see Roosevelt, they could walk in and see Roosevelt. He watched what their agencies were doing. He saw the headlines of attack from Wall Street. He had their back. They knew he had their back, and Wall Street knew he had their back. And the power that lends to a regulatory agency is ephemeral, but incredible. So, I mean, today's SEC doesn't have that. I mean, the longest serving SEC chair in our history was Arthur Levitt, who was appointed by Bill Clinton and served in through the Bush years. He said he never had a one-on-one meeting with Clinton the whole time he served at the SEC. I'd be very, very, very surprised if Joe Biden never met with Gary Gensler, who's the current chair of the SEC. So the regulatory structure, when it is demoted down to this the negligible bureaucracy with where the prime minister or the president or the heads of Congress have no idea what they're doing, no idea what problems they're dealing with. Why should why should Wall Street or why should the city respect them when their own political structure doesn't respect them? I mean, it's as much a problem for us as it is for you. I think it's a problem in almost every jurisdiction. There are a few European countries which I would say of which this is not true, but you can count them on one hand, where the financial regulators actually have access to the highest levels of government. Switzerland would be one, of course. We understand how that works, but that's something that can be fixed overnight. Your prime minister can call up the head of the Financial Conduct Authority tomorrow, bring him into Downing Street. You tell him, okay, I want to know what you're doing. What are your problems? How can I help? Have a press conference afterwards. What do you think that would do to elevate the stature of your regulators? So part of what we can learn from Roosevelt, and part of why I think Taming the Street has so much currency, is it is kind of a battle plan for how to make powerful regulators, how to create a respected, powerful regulator. Now, I'm forced to describe in the epilogue of the book how that was wasted in the Truman years and Eisenhower years, how that was frittered away. But if you look at the origin story of the American financial regulatory system, you can see how this pixie dust of high-level executive attention can really pay enormous advantages.
This is so interesting that, you know, Diana, the cynic in me sometimes comes to the thought that perhaps the system is designed to be ineffective because it's serving the purpose of appearing as though there's effective regulation, when in fact the incentives are so powerful by those who make money as a consequence of weak and lax regulation that they're able to defang the regulators. I'll leave that as a thought. Chris Toby, Chris is your side of the Atlantic, a great TGF supporter over many years. Chris Toby, please do take yourself off mute and share your thought. Thank you. There we go.
Hello, Diana. I don't know if we've met. I may have emailed you at one point or somewhere. I am doing a lot of this in real time. I'm involved in been involved in over 80 of these as an investment expert in litigation in 401k, and basically litigators have become the regulators in the U.S. 401k market. But one of the things that I'm seeing, and this is a point that you brought out, and I'd like your comments on it, is that I'm seeing the U.S. 401k defined contribution market for you all outside the U.S. that they are moving. We are starting to see the move away from federal regulation, mutual funds under the Investment Company Act, which you talked about, to collective investment trusts, which are state regulated. They pretend they're OCC regulated federal, but they're all state regulated. And that's one of the biggest secrets out there, is that we have now moved almost half of all 401k investments away from mutual funds into poorly state regulated collective investment trusts by individual state banking commissioners. And then, of course, they're allowing in those CITs crypto, annuities, and private equity and private debt, non-securities. So that's what's the biggest move I'm seeing right now that I'm starting to be. And then, of course, we're litigating around it and just trying to get to it. But that's kind of the theme that we've just seen so much movement away. And the DOL is just so clueless of knowing anything. I testified to their advisory committee in July, and it's just everybody there's pretty clueless on what's really going on in all these investments, because the DOL, it's such a small part of the DOL, the EBS part. I had one of my cousins work there, and she didn't even know that division existed. And right. So they have such a huge responsibility in retirement, and now that the people are regulator shopping underneath it, moving away out of the only decent regulation we have is the SEC on the state regulators. It's becoming worse and worse every day, and I'm just trying to.
I'm horrified to hear that. I really am. You've disturbed my sleep.
Okay, well, that's what I do. A lot of that.
Good, not good news. We can look at the banking environment and predict how this is going to end, because there were a lot of banks that in the 70s and 80s that didn't want to submit to Federal Reserve and controller of the currency bank regulation, and they wanted state charters, and they got state charters, and that enabled them to set up these flimsy little deposit insurance plans that didn't really cover anything. And then you had bank runs again among these state chartered banks, and the vast holes in this regulatory scheme opened up. So as I say, I'm horrified to hear that this is the reality. And I am astonished to hear, I'm astonished because the federally regulated mutual fund industry has one of the strongest lobbies in America. Their phone calls do not go unanswered in Congress or in Washington. And why on earth they would want to even contemplate an environment where they've got to deal with 50 regulators again. That was the world they faced before the Investment Company Act and the Investment Advisors Act were passed in 1940. They had
Well,
deregulators, and it was to get away from that they supported the 40 acts in Congress. They hated everything the acts did. They would have preferred to have no regulation, but one federal regulator was better than 50 federal. So I'm surprised that situation is allowed to has been allowed.
It's a structural thing because Vanguard has taken such a large portion of the market share in the mutual fund industry in 401k, and their low fees don't allow them to do a lot of lobbying power. So it's basically them and Fidelity, which is kind of a mid-size, but the rest of the industry, mutual funds have sort of been left alone. So they like the less regulatory structure. So I think and of course, private equity has so much money, and the insurance lobby and have eclipsed the mutual fund in influence because of the concentration of Vanguard and Fidelity being the only real big player in there, and the other ones having actually more money that want to get rid of the regulation. So I think that's I'm
glad you're fighting the good fight, but I did want to just pick up on one other thing that you said, because it's going to be especially important on our side of the pond, but possibly as well in the UK as this deregulatory religion continues to spread, and that is reliance on the courts to redress some of these regulatory failures. The conservative movement in the United States has done everything it possibly could to eliminate class action suits. It's done everything it possibly could to protect business from joint complaints by aggrieved investors, customers, whoever, and it's been pretty successful. The current Supreme Court here is extremely pro-business, extremely anti-regulation. Some of the recent decisions over the past year have just been astonishing to me. So I think we're going to need the lawyers are going to need to step up here and start working for a better rule book where they can be more proactive in protection of investors. It's a different environment in the UK. I do understand about the different burden of proof and the allocation of costs in our two worlds. But once upon a time in America, class action lawsuits and class action law firms were an adjunct to our regulatory army. I mean, they were, the guerrilla troops that were out there in the countryside, able to protect investors where regulators couldn't, and many of their cases led to actual regulatory action eventually. So where the work of the lawyers fits into the regulatory scheme here, I think needs to be freshly examined, because we're going to need them more than we ever have.
Well said. Well said. Thank you, Chris. Thank you, Diana. Well, but we're back to JB, and from then on, we'll talk about what can we collectively do to try to make a difference moving forward. I think that's going to be the key question tonight. But let's go back to JB first. Thank you, JB.
Thanks, Andy. Diana, back to the superfan. Apologies. Just you mentioned lobbying and this idea of regulatory capture. Just how bad is that situation in the United States right now? And looking back into history, 2 years after FDR's passing, formation of the Mont Pelerin Society, which obviously pushed Austrian School of Economics neoliberalism into the industry, and that perpetuated through into the Reagan-Thatcher years into the 80s. Obviously, it got a very strong grounding in the Chicago School, for example. How much is that legacy still very, very present in the United States today, and how does it affect legislators and regulation generally?
I love that question. You must know, of course, Justin Fox's wonderful book, The Myth of the Rational Market. I recommend it to every journalist I know. You've got to read it. The capture of the I did not think that the rational market hypothesis, which posits that the market is always right in terms of calculating price and values, I did not think it would survive the 87 crash, honest to goodness, because they've never been able to come up with an adequate explanation of the 87 crash that fits with their paradigm. So I thought that, okay, we're done. call it quits. They don't have a leg to stand on anymore. But I was wrong, obviously. It remains a cherished belief of the deregulators, the anti-regulators, that markets are smarter than we are, and that business is smarter than government, and that rich people are smarter than the rest of us. And that sort of sums it all up. But in fact, we can dispute every single one of those hypotheses, and the rational market is the easiest to dispute because it does not work that way. So I don't think it is as powerful in academia as it once was. I really do think that 87 was the turning point. And now the behavioral economists and the behavioral finance analysts are having their moment, having their day where they say, you know, markets aren't rational because we're not rational. We don't act rationally. We're not all little economists inside the stock market machine. We're human beings. We fall in love with a stock. I mean, you know, and we don't care how many people who bought Apple early ever even looked at the earnings, of which there were none. You know, they just fell in love with all that Steve Jobs stood for and all that so many Tesla investors are exactly the same way today. So obviously we're not rational as investors, and therefore you cannot have a rational market. But while academia has awakened to the flaws in that, what was always a hypothesis, nothing proven, just a theory, academia has awakened up it, but it's always been so useful for conservative lawmakers and policymakers to point to these now discredited theories as a rationale for why they want to do what they want to do, which they want to do, not because it's rational or better for society, but because it's better for their own self-interest. So I don't think it's as powerful as it once was in the world of academia and in the world of high-level market technology. But it still is a useful cover story and needs to be confronted everywhere it raises its silly little head.
Thank you, folks. I'm going to share my screen and just talk about some data that will hopefully enable me to bring a few points to life.
Oh, I saw this slide when I was going through the material you sent me last night.
Thank you. A lot of you would have seen this before. This is the UK version of Violation Tracker, the database that we stumbled across the American version several years ago, and the folks in Washington, D.C. very, very kindly, with a bit of encouragement from us, produced a UK version. I'm going to show you the data for a few particular reasons, folks. So the slide you're looking at here is a list of all the industries ranked by how much they've been fined. And it's frankly shocking that a trust-based and trust-dependent industry, i.e. the financial sector, is on the top of the naughty list with the most amount of fines.
And staggeringly on top. I mean, by orders of magnitude ahead of everybody.
That is right. And interestingly, and I'll provide the data shortly, the US version of this is exactly the same narrative, 3 or 4 times the amount in financial sector than any other industry. But the real worry is this. Allow me to click into some detail here. Now, I remember Mark Carney, when he was the governor of the Bank of England, very wisely saying, in response to the global financial crisis, that the single biggest learning from the GFC was that there was a woeful lack of individual personal accountability. And as a consequence, Mark Carney advocated the idea of some thinking that led to what we then developed and called the senior manager certification regime, which is basically the idea that if individuals within an organization cause mayhem, they will in one way or another be held to account for it. The senior managers certification regime. Why am I mentioning it? Well, let me show you why. So what you're looking at now is a table of individual fines ranked by the largest first. So Credit Suisse, top of that naughty list, 292 plus £1 million, a single fine. Then Barclays Bank, then Glencore, then NatWest, then UBS, then Deutsche, then Citibank, then JP Morgan, then Royal Bank of Scotland, etc. But the worry is, when you scroll down this list, you start to see a pattern. And the pattern is literally the same organizations being caught time and time again for doing the same kind of thing.
Mhm.
And that brings to the surface a very important question. The question is this: if one of the main purposes of regulation is to counter bad conduct, to mandate for good conduct, to drive good conduct into the market, it is clearly failing because this data shows there is extensive recidivism, the same organizations being caught time and time again. One could easily argue that these organizations make so much money by doing the wrong thing that they see the consequential fines as a cost for doing business. And this talks to the point that we have to have regulation that does more than fine the innocent shareholders who have the misfortune of investing through their pension funds, etc., into these organizations. What we need, what we must have, is greater individual accountability. That's what the senior manager certification regime was all about. And I am worried, as many other people are, that the deregulatory agenda is now attempting to unpick the framework that led to the creation, Diana, of the senior managers certification regime. The pendulum is right before our very eyes, moving the other way. So I end up coming back to that worrying question. Are the incentives so powerful and are the lobbyists so effective? And is our democracy so dependent upon election donations and all that stuff, that dark democracy stuff? Is it so rotten that we actually have a system that is engineered to fail? That's a really dark question, Diana. Please do speak to it. Thank you.
It is dark, and it's something that's still haunted me as I've examined our own regulatory history here in the U.S. and looked at where we're going, looked at where we may be going, I should say. I think what I would cling to is, again, the lessons from the New Deal. What we haven't figured out how to do, and what I think we can figure out how to do, is to build a public lobby for investors, for consumers,
Wow.
for citizens. That, you know, if we could accomplish nothing other than to have every voter know that the questions they need to ask that parliamentary candidate or our local congressional candidate. I spoke widely about this in the states before the election. The Congress you're going to elect, said I, is going to have to fix some of the statutes that are being dismantled by our Supreme Court. They're going to have to act quickly to restore some sort of regulatory coherence in the aftermath of those decisions. Pick people smart enough to do that. Ask them how they will do that. But on both sides of the ocean here, indeed in every democratic environment, it is a challenge to get voters to focus on what they need from the regulatory environment. They leave it to the experts, and the experts are the lobbyists. Is it engineered to fail? Only if they're really stupid. I mean, one of the lessons of 1929 through 32 is what happens when an entire country loses its faith in its financial system. What damage does that do?
Wow.
And it is vast. It is vast. The reason Wall Street was willing to even entertain the initial reforms that Roosevelt adopted was they had no choice. They were dead in the water without financial regulation, without government regulation. As I said, we had no financial system. We had no functional banks, had no functional stock exchanges. We had no functional financial system. And if the public could not be brought to trust it again, there was no future for it. And so I think this collapse of public trust in institutions is a far more powerful force than we give it credit for. And I think mobilizing people's demand to be able to trust where they put their money, the people they turn to for financial advice, for retirement advice, being able to trust them is the way to build a dialogue with the public about what their stake in all this is. I was horrified when JB was talking about state regulators overseeing retirement plans instead of the federal regulation that was envisioned in the 40 Acts, because I know about state regulators. I mean, we know how poorly fed they are, how lowly budgeted they are, how little clout they have. If you look at corporate charters, it's a race to the bottom. Who can give business less regulation so that they will come and register their companies here and pay our registration fees instead of Delaware's, instead of Liechtenstein's? I mean, who can give business what it wants so that they will come and play with us? That's what you're opening ourselves up to. And the only solution I can see to it is to reconstruct, and we once had one in the US at least, reconstruct a consumer's lobby, to reconstruct the public understanding of what they have at stake, which, by the way, is why what you guys are doing in TTF is so critically important. You're forcing people to explain themselves. I was so pleased to look at the snippet of BBC coverage that Andy sent me last night and watch this very prime-time, very accessible section of programming. Anybody over their morning tea could understand what was being said and what was being talked about. It's that kind of activism and advocacy that can start to build public support for a strong regulatory arm. Politicians have to be asked, why are you turning to the city? Why are you turning to Wall Street for advice about how to regulate the city and Wall Street? They work for us. They work for us. And so I'm hopeful that the kinds of problems that were targeted in that parliamentary report, the kinds of problems that we've seen here in the states that gave rise to our chaotic politics, and the kinds of problems we're going to see going forward, given Supreme Court decisions that have already been enacted, have to be interpreted for the public as the fruits of this deregulatory lack of care. And if we can do that, it's possible that we can build, as Roosevelt did, a grassroots level of support for strong regulation.
That idea that you just encapsulated there, Diana.
We are the worst long-term investments that could delay your retirement.
Forgive me.
First,
a link just sprang to life. That idea that you just encapsulated there, Diana, the idea of, frankly, an international community of pro-consumer activists working in a civilized and courteous way, not in an aggressive or confrontational manner, just using the argument of common sense and appealing to the wisdom that the tension between the short-term greed motives will create more pain than in the long term than any of us want to bear. We go back to the global financial crisis, as well as the economic carnage. It resulted in 10,000 or so people taking their own lives.
I know. And the same thing happened after 1929 here. Right. I mean, it happens over and over and over again. And I think your wisdom here is to see that helping people understand that on both sides, Andy, helping the citizens, the affected consumers, understand that they've got a stake in how well the regulatory system works, but also helping the financial industry understand that they've got a stake in how well the regulatory engine works. Because once they lose public trust, it can take generations to get it back. My parents would not invest in Wall Street. They were children of the Great Depression. They did not trust Wall Street until their later years. It would have been the last thing in the world they would have done through the 50s and 60s was to put money in Wall Street. Now they should have. They lost out on the earning power of capitalism, but they didn't trust Wall Street because of what they'd experienced as young people. So that's what the financial industry has at stake here. And all I can offer by way of hopefulness is there have been times in history, I document some of them in Taming the Street, when regulation gets so poor, so inept, that even the regulated industry steps up and says, you have to do better because people are stopping trusting us.
Yeah.
People no longer trust us because you are regulating us so poorly. And that can be a very powerful argument, I think.
Dinah, there are various people I'm going to introduce you to, connect you with, to hopefully create the nucleus of something that might grow as a consequence of this conversation. It's such a timely and rich conversation for us to be having, Diana. Honestly, it's like you're a gift that's landed on our plate. You have the credibility that comes with the academically robust work that you've done. But above all that, you have the ability to communicate it in such a compelling way. Your umbrella piece earlier was a cracker. We're going to go to Mark Falcon, and then Martin White's going to take us to a very positive place, talking about the idea of us trying to describe what a well-regulated market would look like. Mr. Mark Falcon, very much. Thank you.
Thanks. Thanks, Andy. Yeah, I just wanted to make a very quick defense of the efficient markets hypothesis as an economist, because I think it is a very frequently misunderstood and abused term. In particular, the clue should really be in the name, that it's a hypothesis. It's not a truth claim. And the nature of a hypothesis is to say that under certain conditions, then certain things might follow. But precisely often to show the opposite, that if those conditions don't hold, so the assumptions under the efficient markets hypothesis of perfect information, transaction costs, then market prices will reflect all information. But that, like all scientific hypotheses, is precisely to show almost the opposite, or to show to the extent to which it holds. So when those conditions are fulfilled, then there are markets that do approximate the efficient markets hypothesis, not perfectly, but to a closer degree. When they do not hold, then the hypothesis breaks down, and to show the opposite. But I think it's and that's the same of all scientific hypotheses. Newton's laws are hypotheses, but is then frequently abused to claim by conservatives to say as reflecting their basic lack of scientific understanding, that it's not therefore something that can be taken from economics as somehow a truth, which therefore justifies deregulatory agenda. But at the same time, but then what I'm really saying is that neither is it invalid. It is absolutely critical methodology.
As you point out, though, how rare it is when the conditions when the assumptions that have to be made. I mean, you know the joke about economists stranded in the lifeboat with a can of tuna fish. Well, assume a can opener, and we'll be fine. So, but that the caveats that those conditions so rarely obtain in the real world, marketplace, it gets lost. I mean, the hypothesis of the market knows best has gone around the world twice before. Oh, the market knows best only if it's frictionless trading, it's free flow of information, et cetera, et cetera.
Yeah,
they haven't put their boots on yet, and so I think the argument, and it's the argument that Justin makes in his excellent book as well, is that people bought the headline and they never read the bullet points below.
But I think the point that I'm also making is that, that those conditions are not binary. They're not binary conditions, that either it doesn't hold, it does hold, or it doesn't. They're matters of degree. So in some markets, then the conditions do hold, not to 100%, but as an approximation. I mean, I give you the example of Newton's laws. Those are assumptions, they're hypotheses. They're good enough for an engineer in most circumstances, but they're not good enough to, say they're good enough to build a bridge, but they're not good enough to fly to the moon. You need a better scientific model. So it's not. So don't throw the baby out with the bathwater. The efficient market hypothesis is a critical tool, but it's when it's abused and misconstrued is when it causes the real harm, as you say.
And part of the problem, of course, has been that so many of its advocates came down on the side or were used, hijacked in some cases, hijacked to defend a deregulatory agenda in government. And I can pull out, and I'm sure you can too, of course, Malcolm, from Adam Smith and from Milton Friedman, the caveats that say, oh, but we do need regulation. Banks do need to be regulated. We're not saying no regulation, but again, those get lost.
Yeah. Adam Smith's abused all the time as an advocate of free markets when he wasn't. He had the caveats, but the caveats get ignored. Yeah.
Really good counterpoints there, Mark. Thank you very much indeed. Thank you. Martin, please do raise this idea that perhaps what we need is an understanding of what a well-regulated market looks like. Martin, please take us there.
Exactly. And the interesting thing is we had an earlier Transparency Task Force meeting today where the final sort of action point was to think not just what a well-regulated market looks like, but what a good for society financial sector looks like. That was the action point we were left with. And if anyone's got any ideas on that, chuck them into Andy. But out of this one, we've had the idea about what a good regulated system might look like. And I'll tackle that just a tiny little bit with the consumer issue was raised just now. Consumers working together. Now, I have it's still a small project called Savers Take Control, under the auspices of the UK Shareholders Association. The principle being savers investors helping each other for free. And the hypothesis here is that the only people that can be expected to tell the public the truth about savings and investment are savers and investors who have the knowledge and are in a position to speak up. Most of the people that have the knowledge are not in a position to speak up because they're working in the sector. And unfortunately, it's very hard to get these critical truths raised in the public domain because they are so against the interests of the financial sector. And the critical truths are things like, don't for God's sake pay for active management, minimize your expenses, and this is how to do it. That leaves all sorts of issues about governance. They need to be faced as well. But if people were told this, and also never give a percentage of your money to anybody, never take any advice that's not on a fee basis, never allow anyone to take a percentage of your wealth, etc. The market has, the sector puts so much effort into deceptive marketing, not quite lying, but almost lying, half truths. And we've drawn the conclusion, and I wrote an essay on this, which won a prize. It's called the Frank Reddington Prize, which you could look up, Diana, quite easily, or we could give you the link to.
I will.
I've mentioned it before on these groups. And John Kay, the economist, was the chief judge on that. And the brief was to write an essay on what's gone wrong with the financial sector and what might help in the public interest. And I looked at the evidence out there, and the evidence is very strong that every 10 years or so we have a crisis. We have an inquiry about it. The inquiry recommends fiduciary responsibility, and the industry bats against it and avoids it. That's the UK. And it's pretty evident from a lot of the things that we've seen, many of which have been raised through and brought to light through the Transparency Task Force, that the financial sector, the regulation of the financial sector is guided by the Treasury, not in the consumer interest. It's guided by the Treasury to make money in terms of tax income for the UK. In other words, they're more interested in the financial sector growing and being profitable than it operating in the long-term public interest. So if today you get screwed by somebody, let's imagine it's St. James's Place or something, that can go on the record, they take X% of your money today, you won't realize until 40 years later that you've got half the pension you should do. They've made the money today. And so the difficulty is where you don't know you're being tricked, and it's too late by the time you find out, if you ever do. So the power of the financial sector is just huge. I think it's the most powerful lobby in the UK community.
Probably in most nations as well.
Yeah, but the UK especially. Yeah. And to do something to tackle that by having consumers speaking up and telling the truth is what's needed.
I agree.
And if we could work on that, that would be rather fun, Diana.
Well, on that note, I think that cues us very nicely to go back to Diana for her closing comments. So, Diana, it's been such a rich conversation. This could go on for many hours.
Days.
I know it could. I know it could. You could write a book off the back of this time and time again. Diana, to you, please, for your closing comments. Thank you.
Well, first, of course, thank you all for your questions and for your attention and for being here. And for inviting me to have a chance to talk with this extraordinary community. I'm not blowing smoke at you, as we say here. I'm speaking as a financial historian who knows whereof she speaks. It's people like you who have made a difference at every stage in the development of a modern economy. People like you who are willing to think about what's not working for the average individual and willing to put some effort and some time and some thought and some passion into fixing it. So I am honored to have been among you today.
Thank you for saying that. Thank
you. It is amazing, and I could offer you many examples from history where the mobilization of public opinion has been the critical factor in producing better regulation. I wish I could close with some happy talk, but I can't. I think we're moving into a very challenging period in which the defense of common sense regulation in the public interest is going to become more and more challenged and more difficult, which is only to say that you're far more important now than you would have been 20 or 30 years ago. But it's an effort that we have to continue. There's so many spokes to it. Financial literacy in our schools, financial literacy among our electorate, financial literacy among government employees and regulators, pensioners, that can sometimes seem very daunting. But I keep coming back to something that Roosevelt said, my favorite guy, my go-to guy, but something that Roosevelt said on the eve of the 1938 midterms, when he said, to save democracy, we have to make democracy worth saving in the eyes of the American people. To make regulation work, we have to make regulation worth saving in the eyes of the people it's supposed to serve, the people it's supposed to protect. And this is it's a vast education project, but it is just education. You don't have to change the world. You just have to do the educating bit, and the world can start to change. So my blessings on all of you who are giving your time and your effort to that. And as I told Andy yesterday, I'd be delighted to be of help in any way I can. So thank you for having me today.
Diana, thank you. We're going to be doing all we can to capitalize on your wisdom and your insights and your generosity of spirit. I'm going to close with three quotes from three Americans. The first I'm going to refer to is Charlie Munger, Warren Buffett's right-hand man. His one sentence explains probably most of the problem we're trying to unravel here. He talked about incentives. He said, show me the incentives and I'll show you the outcome. And I say this because, of course, there are those who are very highly incentivized to think short term, act short term, and the short-termist actions causes a lot of pain and a lot of misery in the long term for many others, including ultimately themselves. And that's the wisdom you're bringing to this conversation, Dinah. You're helping me and others see that actually it's bad for everybody, including those who are just profit-centric, to actually create a landscape of lax and weak regulatory frameworks. There's tremendous wisdom in what you've been saying around that, Diana, and you really are opening up my eyes to it. The second quotation is about purpose. David Pitt Watson, one of our senior members, spoke today about the importance of trying to define what the UK's financial sector, or the financial sector, what is its true purpose. And the quote that comes to mind is Mark Twain. He said, the two most important days in a person's life are, number one, the day they're born, and number two, the day they discover why. And that idea of discovering why we're here is what has helped me and many, many others understand the difference and the important difference between achievement and fulfillment. Yeah. To cannibalize that phrase, culture eats strategy for breakfast. I would say that fulfillment eats achievement for breakfast. If we feel we're here for a reason, then what more could we want in life? I mean, that's it. And the third quotation I'll close with, if I may, is one I find myself referring to and thinking about very frequently, especially when things aren't going well, when you need to really tap into a sense of inner resolve and purposefulness. And it's Robert F. Kennedy speaking, of course, in the 60s. Forgive me, it's just loading up here on my page here. Robert F. Kennedy. Every time we turn our heads the other way, when we see the law flouted, when we tolerate what we know to be wrong, when we close our eyes and ears to the corrupt because we are too busy or too frightened, when we fail to speak up and speak out, we strike a blow against freedom and decency and justice. And that, I think, is a sentiment that can bring us all together with a sense of common cause and a sense of purposefulness. And Dinah, your insights have been a real gift to our community.
I was delighted.
Once again, I'd like to thank you on behalf of everybody else for being with us tonight and for being open to collaborating in some way. Let's all show our appreciation again to Dinah, not just to Dinah, but also to everybody for being part of a very rich conversation tonight. Thank you, Dinah, very much indeed. Thank you all very much indeed.
Thank you again. I hate to leave, but I must. Thank you. And thanks. This is the beginning of a conversation. Thank you.
Thank you very much indeed. Bye-bye. Bye-bye all. Good night.